So now, ladies and gentlemen, I believe that you did have a good break to get some refreshment to start the session 2. This is your MC, Moon, joining you at the G20 Global Financial Stability Conference 2021. In session 1, we looked into the macroeconomic conditions of the COVID-19 era. In session 2, we'll talk about digital currencies which emerged during the acceleration of digitalization of the economic structure due to the COVID-19. Just how will digital currency affect the financial market? We'll now share our thought regarding the digital currency and their micro-financial implications. So, ladies and gentlemen, the Gelsomina Vigliotti, Director General for International Financial Relations, Italian Ministry of Economy and Finance, will take over as the moderator in this session. So, everyone, let us go to Italy. Hello. Hi. Is there Gelsomina Vigliotti? Can you hear me? Hello? Can you just check out the sound? I think she can't hear me. So we're going to check out the technical problem once again. So, hello.
Hello, hi, good morning. Good morning, good afternoon.
Good afternoon. Thank you very much for joining us despite the time difference. And would you please lead this session as a moderator?
So thank you very much. And first of all, I would like to thank you, the organizers, for inviting me. I'm Gelsomina Vigliotti from the Italian Treasury. Leading on the G20 presidency, the Italian G20 presidency, and I'm very glad to be with you today on this session to moderate the session on the digital currencies and their macro financial implication, a topic which is very high on our G20 agenda, and so I'm very glad to be here with you. As all we know, digital innovation in payment system has gathered pace in recent years, and in part as a response to the rise of so-called cryptocurrencies. And in response to the excessive volatility of these, the market is now developing so-called stablecoins, privately issued digital currencies that promise to fulfill better the store of value function of money. As you know, the G20 has repeatedly warned against the adoption of global stablecoins, while adequate regulatory approvals are lacking. At the same time, many central banks worldwide are also considering, and in some cases already testing, official central bank digital currencies. What matters for today's discussion is that each of these different types of digital assets raise many new questions and challenges for policymakers, including at the G20 and beyond, the core issues of monetary policy and banking regulations. Indeed, the potential impact of digital currencies will be also discussed tomorrow at the G20 International Financial Architecture Working Group. And this discussion is well-timed, is a well-timed event, will certainly provide the precious insights to reflect upon. Our first presenter today, Yoon Sungguan, will help us better understanding the features of the different kind of digital assets, their advantages, and why we may need to adopt CBDCs. Yoon Sungguan is currently the head of e-finance division in the payment and settlement department of the Bank of Korea. He has a wide experience and a comprehensive knowledge of the payment system, having worked for years on these issues, both as a researcher and as policymaker in the Bank of Korea and at the Bank of International Settlements. Our second presenter, Caroline Malcolm, will explore the possible policy implications of the rise of digital currencies. Caroline Malcolm is a senior advisor on blockchain and tax at the OECD. After working for years on the issues of tax transparency and base erosion and profit shifting, she developed an interest in the tax treatment of cryptocurrencies, becoming the founding head of the OECD Global Blockchain Policy Center. The length of each presentation is 15 minutes. The presentation will be followed by panel discussion, where each panelist will give comments on the previous presentation in 7 minutes each. Then we will have a Q&A session, and we'll collect questions both from the on-site audience and from online participants. So, without further ado, I would like to invite Sungguan for his presentation. Sungguan, are you there?
Moderator. Okay, what I'm going to try to present in this session is the title is what are global stablecoins and CBDCs. So, okay, hello everyone. First of all, I want to thank the organizers for giving me an opportunity to share my thoughts on stablecoins and CBDCs. As a disclaimer, what I'm presenting here today is my own personal views and do not represent the official view of the Bank of Korea. Okay, to begin, we will look into what are stablecoins and then take it one step further into global stablecoins. As you already know, Bitcoin is, I think, is a great innovation in terms of technology because it provides somewhat solution to double spending problem. This is really a big issue in payment area. So copying and duplicating data on computers is very easy. For the reason, peer-to-peer transfers of electronic money may not be possible with full confidence in settlement of finality. However, the first generation of crypto assets, Bitcoin, has proved that the problem can be solved by aligning the system participants' efforts with the rewards, that is, which is called mining, to prevent data tampering. So compared to the extent of achievement in terms of technology, Bitcoin, I believe, has not been that successful so far in making itself into an internet money. Due to high price volatility, it has failed to adopt and isn't used as a daily medium of payments. Its failure as a payment instrument can be easily verified by the sheer volume of transactions and the degree of competition in the stablecoin sphere. Stablecoins have been replacing Bitcoin itself even among crypto asset transactions. Unlike Bitcoin, stablecoins earned trust from outside by piggybanking on outside sources such as fiat currencies and financial assets. Okay, stablecoins are categorized. Okay, this is a classification of stablecoins. Okay, stablecoins are categorized by and large into two groups. As you see that the first one is asset-backed, the other one is algorithm-based. Okay, in this presentation, due to time constraint, and even if they are in themselves a very interesting topic, but we will focus on the asset-backed stablecoins. Asset-backed stablecoins, again, can be further into, as you see that, into grouped into four types. First one, fiat currency-backed stablecoins. They look quite much like electronic money, e-money, we call it, but have a different architecture. So fiat currency stablecoins, because it's stablecoins, which is named currently as a money tokens in the EU regulation, are based on DLT, distributed ledger technology. It's a kind of, you can see that the blockchain technology architecture. So in contrast, e-money is a quite a common, it's a prepaid card and such kind of stuff, is based on database architecture. Database architecture is a legacy, I would say that a legacy database. So it is commonly adopted and utilized in the various areas. So although the term fiat currency stablecoins implies they should be backed purely fiat currencies, but in practice and by the mercy of related regulations, the issuers can hold sometimes highly liquid short-term treasury bonds on the asset side of the balance sheet. The second one is a fiat financial asset-backed stablecoins. The financial asset-backed stablecoins issuers hold on the asset side of the balance sheet mostly treasury bonds, commercial papers, including some fiat currency. Most of the stablecoins that are now circulating belongs to this category. Third one, tangible asset-backed stablecoins, backed, for example, by petroleum and gold. There were a couple of trials, like at Venezuela, but they have not been successful. The last one is a crypto asset-backed stablecoins. An exemplary case is DAI, D-A-I it is called, which is issued by the MakerDAO network. Okay, if you're interested, and you can just Google it, and then very interesting. Okay, through this network, anybody, so you and me and anybody can issue DAI, D-A-I, as long as you have a Bitcoin and Ethereum. You can collateralize Bitcoin and Ethereum to issue DAI. Okay, so I'm gonna go back to here. Although stablecoins have been successful in gaining lots of traction by differentiating themselves from Bitcoin and Ethereum, their use is still mostly confined to the crypto asset sphere. In the crypto community, although they are accepted as money and redeemable to fiat currencies, stablecoin issuers do not guarantee, this is important, the redemption at par value at any time. The reason why can be easily understood when you look at their reserves composition. You can see the next slide. Okay, this is circle. This is, you call it USDC, USD coin. This is a really, market share is really high, and probably at the second it has a probably top second, I think, that in the market share. Let's take a look at USD coins reserve composition to see why it may be the case that although the stablecoin issuer Circle holds, as you see there, almost 60% of its reserves in cash and cash equivalent, as you see that commercial papers and bonds, if you add it up, that is more than it's almost the 14%. In a situation where the market risk increases, the issuer may face a challenge selling those assets at a reasonable price. So, and as a consequence, it may find it hard to honor redemption promises they made before they issue those coins. Okay, now turn to global stablecoins, but it's not much different from stablecoin, in general stablecoin. As its name implies, this is a kind of a stablecoin, but it's differentiated by the sheer size of user base and its expected transaction volume. It is also differentiated, furthermore, by the possibility of it being used beyond the issuer's jurisdiction. So it's a cross-border, it's going to be used at cross-border. There is not, but here is that there is not yet global stablecoin that fits this definition. However, as you are well aware, Facebook is preparing to launch its stablecoin named DM, formerly known as Libra. Facebook claims that DM aims to enhance cross-border payment services. In passing, actually, I wanted to emphasize here that when global stablecoins are actively used across the countries, that can cause various thorny issues, not only regulation, but also central banks. Because of a time constraint, I'm not going to talk about much on these topics. So, okay, we're going to take a glimpse of how the Libra is going to be architectured. Here's in the top panel, as you can see, the top panel, the Facebook issues 4 different stablecoins, each for US dollars and the pound, the euro, and the yen. As you see there in the right column, in the first panel, that with a smart contract, you see that smart contract, they can be converted to Libra, LBR, which I think it will, this is my just the projection. So it's a kind of LBR is going to play a role as a bridge currency between those stablecoins, Libra dollar, Libra pound, Libra yen. So it's going to be, seems like an SDR, looks like an SDR. So in the bottom panel, that you can see the Libra will operate, the second panel, that Libra will operate in a blockchain layer. So this is quite a different blockchain technology. And many other third party, the last panel, as you can see there, and the third party service providers, including Facebook itself, can provide digital wallets. Okay. Now let's move to legal issues related to stablecoins. As we have discussed in the previous slide, fiat currency backed stablecoins is very much similar to e-money, electronic money, that I would say that is a prepaid card. So according to EU e-money directive, e-money, electronic money means, here's the definition, it's a blah, 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 blah. But this is a long definition, but you can easily grasp it by simply equating e-money to prepaid card in a kind of topped up balance, for example, in a PayPal account. The critical difference between fiat currency stablecoins and e-money is only the underlying technology. As I mentioned, the fiat currency stablecoins is based on the blockchain technology, but e-money is based on the database. This is legacy technology. So e-money directive, here's that, imposes a very restrictive requirements on issuance and redeemability. Issuers have to redeem the unspent balances at any moment and at par value to a fiat currency. When the EU stipulates a regulation regarding stablecoins, whose draft is circulating now under the name of MiCA, I expect the fiat currency-backed stablecoins will be treated like the e-money. Regarding the other assets-backed stablecoins, we may see EU position in the following statement. Okay, this is a joint statement. It's made in last year. Okay, the joint statement made by the 5 ministers of finance says that whether it is a fiat currency-backed stablecoins or financial asset-backed stablecoins, they have to meet the following requirements. First, the stablecoin issuers should pledge their commitment to one-to-one convertibility between the stablecoins and the fiat currency. Second, eligible assets for reserves should be limited to deposit or highly liquid assets. So there are still more, requirements there. So as you can see that from this requirement, we can interpret that they are okay with e-money. The e-money is a really current type of electron money, but would not. This is my just guess. This would not accept asset-backed stablecoins. It seems that they are much. I think that I'm not lingering on this issue, but it's, I'm just in passing. I'm just wanted to mention that this one. So I think that they are much concerned about the possibility that stablecoin issuers also participating in money creation. As you all aware, that banks and central banks can create money, right? This is a currency that is circulating. But in stablecoin schemes, actually unregulated stablecoin issuers can create money. So they're just circulated, right? So I think this is my guessing. And then second one is that these finance ministers really they're really concerned about the second possibility, that is non-euro denominated stablecoins are circulated in the EU area. So really they are much concerned that such a case that Facebook, when they issue and then Libra and TM is circulated in the EU area and then adopted heavily, widely, and then Facebook would change their mind and that, okay, we're gonna from now on, we're gonna change the denominator from Euro to Libra, something like that. So they are quite much concerned about that. So this is current legal regulations. Okay, but unlike the EU, US, we're going to look at a US case. US has not yet developed a unified framework for stablecoins. EU had to and it has to do this because there are many member states that have different rules and practices to prevent regulation arbitrage, and at the same time to facilitate the payment innovation in the euro area. The EU needed to provide a unified framework, but US didn't. So although US does not have any federal level legal framework, they can apply it across states. Some states, here is the New York and the Nevada, some states have developed their own solutions. The first one is the New York Department of Financial Services model. That would be a stablecoin issuer finds first needed to secure limited purpose trust. So, okay, they are first establish a trust company, and once it's chartered as a trust, the issuer seek additional approval to issue stablecoins. So here's this example is a Paxos Gemini. The Gemini Paxos dollar and Gemini dollars are issued under this regulation. And the second model is slightly different from the previous one, but the concept and approach is very similar. So the authority in Nevada has not explicitly acknowledged the trust or may not, trust here, trust may or may not engage with the stablecoin issuers. So this is state's obscure legal position. Stablecoin issuers are piggy banking on Nevada state chartered trust to issue stablecoins. Here's an example is a true USD. Okay, next one is this is the approach that one of the biggest stablecoin issuers, Saiful, as I mentioned before that, has adopted. So it has acquired a money transmitter license. Okay, this is issued by each state. So they're going to go to 44 states and then got an approval. So, and then last one is this official model. I would say that this is Tether. Tether is incorporated in a Hong Kong area, Hong Kong jurisdiction. And then now it's there's a legal issue between the New York state and then the Tether, but it's also so the Tether is not much used in the New York area because of such a regulation. So, okay, next topic is CBDC. CBDC is this is people are really confused. This is quite a much different concept, but this is a very similar kind of stable coin. But it's the difference is that I think the most different part is that who is going to issue this digital currency. Okay, so I would say that CBDC is kind of defined as this way. It's a central bank issued, so the issuer is a central bank. And then what kind of things is issued? That is a digital representation of a sovereign currency, so that I'm going to call it simply digital cash. Because the central bank has already provided digital money in the way of reserve money. In particular for financial intermediaries, we needed to put an emphasis on the term here is a new form. So to put on a new form, it may be issued, for example, as a bearer instrument, like a cash, but in a digital form for the general public. With, I would say that a programmable functionalities, something like that. So here is just sketched the two different kind of CBDCs. And here's the online CBDC and an offline CBDC. Probably you've already seen it a lot kind of cases. The CBDC, online CBDCs. It's simply pay. What in Korea that is common is that Kakao Pay and Naver Pay. It looks very similar, but this is based on DLT here. So. And the second one is offline. This is offline. You have two smartphones, and you can just bang it, and then money is transferred immediately. That's the way that it works. Okay, because of a time constraint, I think but I have to go. So this is very important because this is a lot of implications to the central banks and the financial intermediaries. Because how can we architect CBDC's roles and central banks' roles and intermediary roles is quite much different. Looks kind of so because of the time is already past. So I'm gonna just if you give me a couple of minutes, I'm gonna just hang on it. Here are three possible technical architectures. The first model is a single-tier model. We call it single-tier model here. It's CBDC transactions and resemble transactions with the commercial banks, except accounts would be held with the central bank. And a payer would log in to an account at the central bank through a web and a mobile application and request a transfer of funds to a recipient account also at the central bank. The central bank would ensure settlement by obtaining master ledger, but only after verification of a payer's authority to use the account, enough funds, and the authentication of a payer's account. Okay, this model gives central banks more control over the product design implementation process. Here is however, the single-tier model requires a central bank to assume active role in distribution and payment services. They may exceed the scope of its core mandate capacity. So here is that, moreover, central banks in this model would directly compete with existing digital payment service providers, so creating disintermediate risk. Okay, here's because of time constraint, I'm gonna just briefly talking about this is a two-tier model. The tier one is that who is gonna issue, the central bank definitely issue, and who is gonna distribute, who is gonna take care of a customer, then definitely the intermediaries that or third-party service providers. So here is two different, two-tier retail CBDC. There's two different kind of a model. There is a hybrid CBDC. This is experimented in my bank right now. Here is that each customer's balance sheet is kept, right? This record is kept by the central bank ledger. Okay, this is the difference. Intermediate CBDC case is that central banks only keep records of a total amount of CBDC issued to intermediaries. Okay, this is the difference. The second one case is that central banks cannot look into individual payers transactions, so privacy is going to be really protected, right? So central banks are really now judging that which one is better for their, looking at when consider of their capacity and legal privacy issues. Okay, this is this model is mentioned a lot in PIS paper and other areas, but it's disregarded because this is not a CBDC. This is some people call it is a synthetic CBDC, but it is not CBDC because the CBDC, when CBDC holders should have a claim on central banks, but this model actually that CBDC holders claim on issuers that is just the intermediary. So there is a legal separation between CBDC and the CBDC holders. So basically legal perspective, this is not true CBDC. So I'm gonna call it, this is a CBDC-backed e-money, but this is a new term and I just coined. But this is called by synthetic CBDCs by IMF staff. So, okay, here in this indirect model, I said it before that it's a CBDC, synthetic CBDC. Well, I would say that this is not CBDC at all. So I'm calling it CBDC-backed e-money token. But here, that probably you heard a lot of that, monetary history that this is a full reserve banks. The full reserve banking, we tried it a couple of times, but I'm not sure that whether it's. I think it is probably failed so far. So without central banks, really now this is really kind of struggling. If we issue CBDC by ourselves and operate the system, related system, this is really a lot of burden on us. And then, even though we do not facing customer, but actually there is lots of legal issues central bank might be involved. So I think that many central bankers are really concerned that, probably think that, would not probably issue CBDC. Instead, they might try the different kind of approach. That is just one approach, is the full reserve banking or CBDC-backed e-money, right? So as long as central banks have a supervisory power on intermediaries, might be the two options might be possible. But the second option is that I will wanted to more add it on. The full reserve banks, here is that to have a full reserve banks, intermediaries, it might be the big tech and the fintech, they have to first have a master account with the central banks. But the central banks are really reluctant to open master account to those fintech and big techs. So central banks are now struggling whether to issue CBDC, but it's a lot of burden. But the other approach is okay, let CBDCs, we're going to issue and then intermediaries take over CBDC and backed on CBDC, and they're going to issue e-money. And also the other option is the full reserve banking. But this is really we have to look at what kind of implications that have if we adopt the full reserve banking. Okay, I'm going to stop here and then thank you for your time. Okay.
Thank you very much, Sungguan. Indeed, the range of possible CBDC designs make the policy choices, if possible, even more daunting for central banks. So it's very interesting indeed, your presentation. And now let me pass the floor to Caroline for her presentation. Caroline, the floor is yours.
Thank you very much. And I will just bring up my presentation so that we can get underway. Thank you very much, too, for that fantastic introduction to the world of central bank digital currencies and stablecoins, the future of money. Good morning, good afternoon, and good evening, everybody. I'm Caroline Malcolm, Senior Advisor on Blockchain and Tax at the OECD. And I'd just like to really start by saying thank you very much for the invitation to contribute to this discussion on a topic that I think with good reason has really captured the attention, not just of policymakers, but of the world of finance, of tech, and increasingly the population at large. So I was asked to speak today focusing on the macro financial implications of developments in digital currencies. And so over the coming 10 to 15 minutes, I will, of course, narrow in on those. But for reasons that I hope will become clear, I'm also going to spend some time really focusing on some of the broader policy consequences of these developments we're seeing in terms of the future of money. Consequences and tools which will be shaped by and could also be, though, used to shape the future of money. Before we dive in, though, I'd really like to mention that in preparing this presentation, I was fortunate to be able to draw on the work of a number of my colleagues here at the OECD who unfortunately weren't able to be with us today, including Lila Demu, Kenton Sago, Robert Padalano, and Michelle Harding, as well as a rich and growing literature from our colleagues at other international organizations, in academia, as well as, of course, from industry. But nonetheless, as with Sungguan, these are my personal views and should not be taken to be the views of the OECD or its members. So without further ado, I'd like to focus first on some of the use cases and gaps that digital currencies are considered to be useful candidates to address. So really, what is the goal of developing a central bank digital currency and or a global stablecoin? For what purposes will they be used, and on what basis will we be able to consider whether their proposals and the reality have indeed been a success? Now, we've been fortunate to have an excellent presentation to already demonstrate to us that when we're talking about CBDCs and GSCs, there are indeed a number of different models that we can be talking about, and the And with those different models come very different macro financial implications. For example, in the case of CBDCs, a wholesale CBDC perhaps would not involve widespread changes to the current monetary system, and also protecting, obviously, the two-tier system based on commercial bank intermediation. However, the flip side of that is its ability to improve the cross-border payment system, which is, as we're going to talk about, one of the primary drivers or reasons given for developing these types of tools would, of course, be somewhat reduced. And then in contrast to that, what we think of as sort of a universal CBDC, either a hybrid model or one of the intermediated models that we've just had described, or sort of a direct-to-consumer retail CBDC, would obviously be a far more radical change. And depending on the particular design, could include substitution of commercial bank money by central bank money, and obviously therefore raise several questions in terms of monetary policy and also on credit allocation. But for the purposes of this discussion, I think I will consider the implications of two-tier retail central bank model. And when it comes to global stablecoins, I want to think of them both as a standalone product, similar to USDC or Tether, as we've already talked about this morning, or as an instrument which is integrated into a broader social or e-commerce digital platform, as was proposed under the Facebook-led DM initiative. So with those kind of caveats on what we're going to talk about, I just want to come back to this question and really think about, what are some of the leading reasons given for establishing a CBDC or GSC? And firstly, I think the one which comes top of mind and first in all the discussions is in regards to payments, and in particular cross-border payments, where especially at the retail level, current services really remain rather slow and expensive, both compared to institutional cross-border payments, but also domestic payment systems. And I think if we can just pause a moment to look at what the current payment systems, it will help us understand better the attraction of these new forms of digital currencies. So firstly, the international payment infrastructure is largely dominated by a few large payers, constituting the so-called correspondent banking system, with roughly 90% of cross-border payments by volume being handled by correspondents, with the remaining 10% being led by money transfer operators like Western Union. There's also a huge number of concentration in terms of the number of correspondents each individual bank relies upon for wire transfers. Secondly, the current system remains really costly compared to domestic payments, with financial institutions realising a margin of close to 20 basis points when it comes to international transfers, compared to around 2 basis points for domestic transfers. And thirdly, in terms of the current systems, we have seen that, there is a significant lack of interoperability between domestic payment systems, and that, of course, adds even greater costs and inefficiencies into the system. And cross-border payments are obviously used for a variety of different reasons, but one of the most important, particularly from a policy perspective, is in relation to remittances. And I think this audience is probably very familiar, not just with previous targets that are taken by the G7, but also the current Sustainable Development Goals targets in relation to remittance cost, where we see that the current global average remittance cost is around 7%, and the goal is to drive those down to under 3%. Now, 7%, of course, the average, we see huge variation there, up to 20% in some payment corridors. And obviously, there's a huge room for improvement where we think about where we've managed to get to in terms of domestic payments and bringing those same efficiencies to the cross-border payment system. Now, before we even think about digital currencies, there's obviously already been a number of efforts to improve costs and efficiencies in the cross-border market. But notwithstanding those recent initiatives, I think there's still a huge amount of room for improvement, I think we could say. Now, secondly, in terms of looking beyond payments, why else create a CBDC or a global stablecoin? And really this idea of digital ecosystems. So the idea of having, in a sense, an in-house digital currency to complement existing platforms, both in terms of e-commerce, but also in terms of big tech's expansion into fintech. But there's also new platforms. The rise of asset tokenization means that platforms that we perhaps haven't even conceived of today, in the same way that 10 years ago we hadn't conceived of platforms like Amazon and so forth, in a new, far more digitalized world than we already live in today, we can see that, and with the rise of tokenization of assets, whether they be native digital assets or real world assets being tokenized, we can see the likelihood of new marketplaces opening up, new platforms, and really the importance of having a well-designed digital payment system which can integrate to really maximize the efficiency gains in those systems. Thirdly, one of the other use cases often cited in this space is to do with transfers. And of course, here we have the ready example of recent and in some countries ongoing social transfers to provide support through the pandemic. Now, the nature of those payments has obviously varied significantly, from going from one-off payments to much more regular transfers, from programs that targeted specific sectors through to programs that were much more universal, albeit with certain qualifications or thresholds. And what we've really seen in watching those payments sort of play out is that due to their urgency, rather than providing support through other means, for example, through the tax system, direct transfers have often been used to provide the support that has been needed in the time that has been needed. And those transfers have relied on distribution systems, mainly through the traditional financial system. And in some ways, we found that those systems perhaps have not been as optimized we've hoped for, both in terms of the speed at which those payments can be made and really get getting those funds into the hands of the people that need it on a very urgent basis. But also in terms of targeting, for example, being able to make sure that the payments actually end up in the hands of the people that were intended for. So there's obviously some areas there where we've been able to see that, perhaps the current system isn't fulfilling the potentials that new technologies, new ways of doing value transfer can really offer, and thinking about what some of these new systems might be. Fourthly is around financial inclusion, and the rationale here tends to be twofold, both domestically to facilitate people's access to financial markets through a digital infrastructure, being cheaper than a physical one, and on the international level to allow countries to access reserve currencies more easily, fostering trade flows, and really addressing perhaps what might be shortfalls in their domestic systems. And finally, digital creation of a digital public good. And obviously this applies in the case of a central bank digital currency and not so much a global stablecoin, but really about, and this is really the point though, is about ensuring the maintenance of public money. So cash as a public good with the properties it has, but bringing that into the increasingly digitalized world that we live in. We can talk a bit more about where we're going to be going in the future. And I really think that what we're seeing at the moment is just the beginning of a far more digitalized world that we will live in. So now we talk about digital currencies, and the question is sort of posited here as if there is sort of little distinction, perhaps with the exception of that last point about digital public goods. There's perhaps little distinction between central bank digital currencies or GSCs in terms of their usages. And there certainly can be similarities between the two in terms of what functions they might fulfill. However, when we think of money as a conduit for achieving macroeconomic or other policy objectives, there's obviously some very important distinctions between a central bank issued digital currency and a private entity issuing a global stablecoin. And so I'd like to talk a little bit about those differences. So starting to get into those sort of macro financial implications of digital currencies and other policy consequences by really just focusing on one of the use cases. We unfortunately don't have the time to dive into all of them, but really I want to look at the payments use case, and in particular talking about the existing cross-border and domestic payment infrastructures and the implications that CBDCs or GSCs have for those. So as we've said, improving payment infrastructures, both cross-border and domestically, is really one of the most prominent use cases cited for the establishment of these new forms of money. And in terms of where we stand today, traditionally, payments infrastructure domestically is often sound, as I've discussed, although we have seen in the last 10 years that in some countries, challenges of financial inclusion have driven innovation even at that domestic level. To improve access to the domestic payments infrastructure, for example, through the development of mobile money initiatives, like M-Pesa, the most commonly cited examples, but also integration of those products, those mobile money products, with non-financial services such as healthcare. So there's programs in Kenya, for example, which integrate these mobile money with healthcare services, for example. So this cross-sectoral integration that we think about often as only being a feature of these new forms of currency is in fact not really dissimilar in some ways to what is already proposed by some of the stablecoin initiatives that Sungguan has already spoken about this morning, albeit on a much smaller scale and a much scalable environment, and also with less reliance on what has been coined as this phrase of DNA, of data, network, and activities loop. So that's obviously a big distinction and a big leap forward in terms of, although those existing frameworks are similar, what we're looking at now is sort of a supercharged, a turbocharged opportunity for the growth of those really integrated models between financial and other digital services. So, the proposition here is, the opportunity to improve payments. But what about some of the other consequences that might flow from taking those measures? And the first one here is currency substitution pressure, and with it, the risk of monetary authorities' control over domestic liquidity, including through reducing the stability of monetary demand. and as a result of this, the sort of transmission of monetary policy could, of course, be weakened. Now, in some senses, there's really no difference in the nature of the risk from currency substitution, depending on whether that occurs with currencies in their traditional form, so the currency substitution we already see, versus what we would see as under a central bank digital currency or stablecoin. So the type of risks are perhaps not different. However, what does change is the ease of access offered by these forms of currencies, and particularly in the case of stablecoins, also the breadth of economic and trade links relying upon them, due to the likely scenario where, the propositions we've seen in terms of integration of those stablecoins with large digital networks. So again, you're going to see perhaps an increase of pressure for currency substitution in particular markets. Secondly, is this idea of currency mismatch risk. So I guess, why is this particularly severe? Why is this risk particularly severe in the case of central bank digital currencies and global stablecoins? I think at a very basic level, and not dissimilarly to what I've just said about currency substitution pressures, is that due to the greater availability of what we can call these sort of foreign currencies, whether these be CBDCs or GSCs, due to those new funding options in the area of trade finance, for example, which may only become available in those foreign currencies, foreign in inverted commas. And so again, it's not necessarily that the risks are new, only that there will be even greater pressure for those to arise in a system dominated by central bank digital currencies and global stablecoins. And then third and fourthly, and I think, with the important caveat, without appropriate controls. So if we don't have appropriate controls, if we don't have the right, legal and regulatory frameworks, some of which have already been talked about, in place, then we also have some other risks, and that relates to, exchange restrictions and capital flow management, and also this issue of illicit flows. And illicit flows, a lot has been said, I think, on this topic already, and conscious of time, I won't delve too much deeply into this, but obviously the Financial Action Task Force is very focused on looking at how AML and CFT standards should apply to virtual assets, including different forms of digital currencies. And obviously, again, the enforceability of exchange restrictions and capital flow management, again, it's not that perhaps there's new challenges there, but it becomes even more difficult, perhaps particularly so with GSCs, but also perhaps with central bank digital currencies, depending on their design. I will say, though, perhaps just before we move on, to quickly look at some of the broader policy consequences, is that the technology that we're now looking at also offers some opportunities in this regard. So illicit flows is a good example where, because of the nature of distributed ledger technologies, which is in most cases the foundational technology on which these coins are built, we in fact may have better tools for tracing illicit flows, better tools for working out who is behind these illicit flows than we've ever had, particularly, obviously, if the comparison is made with cash, but also perhaps also with other forms of existing traditional financial transfers. So all that to say, it's important also to look not just at the risk, but also how we can use these new technologies to also support or place safeguards, guardrails around some of the concerns we have of issues that might arise from the introduction of these new forms of money. But just perhaps moving very briefly beyond the sort of macroeconomic to think about some of the other policy areas that are likely to be implicated by the introduction of these new digital currencies. And I'm just going to, given time constraints, just really focus on a few of those, in particular on tax and competition, because I think they raise some interesting issues that can highlight how existing policies may be applied to CBDCs and GSCs and the challenges in doing so. So tax is a very interesting area, as it's one place where we can really see the potential for divergence in how CBDCs and GSCs are treated by policymakers. Now, the OECD has recently completed a study of about 50 countries looking at the tax treatment of virtual assets, and in particular in relation to cryptocurrencies. Now, to summarize and really to simplify the nuances of the findings, as it stands today, the majority of countries treat cryptocurrencies as intangible property for income tax purposes, meaning that they will generally be subject to tax when exchanged for fiat currency. And then there's some divergence about whether they will be, there will be a taxable event when it comes to moving between two different cryptocurrencies, for example. But on the other hand, that's the income tax situation. For indirect tax purposes, VAT or GST, these currencies are treated as equivalent to fiat or foreign currency. But thinking about in the context of central bank digital currencies or global stablecoins compared to these traditional cryptocurrencies, we can imagine that when it comes to central bank digital currency, which at its core is really just a new form of the existing fiat currency, that the CBDC will be treated for tax purposes as equivalent to other forms of fiat currency. But that correlation is far less clear in the case of global stablecoins, particularly as we've discussed, where you might have different assets backing, or even a basket of assets backing those stablecoins. So for today, instances of private money, such as the commercial bank money that we use predominantly in daily transactions, is treated as central bank money for tax purposes. However, if the global stablecoin is based on a basket of assets, for example, whether those be a basket of fiat currencies or other assets, or even if over time global stablecoins become an independent unit of account, it's really not clear that the analogy to today's private money in terms of the tax treatment holds. And in that case, you may have a situation whereby the more complex rules relating to the tax treatment of cryptocurrencies apply to global stablecoins, and a more straightforward treatment is applied to central bank digital currencies, which may have, of course, implications in terms of their usability by consumers on mass scale. Now, I'm conscious of time, so I won't, in fact, dive into...
Yeah, Caroline, sorry, you are already 7 minutes over time, so, Absolutely. If you can, yeah.
Thank you very much. So I just wanted to mention there on the screen, you can see, I think, some of the things that we need to be thinking about in terms of, whether, and this is in terms of looking at that underlying technology and whether it be in the area of digital currencies or areas, some of the issues that policymakers might need to be thinking about as they look to explore these areas. So issues around interoperability, data management, digital security, governance, internal governance of these tokens, in the case of private coins, accountability in terms of responsibility for compliance, and then of course education, as we are moving to a very, very different model. I will just take a moment to really emphasize, in my view, the importance of this interoperability in terms of addressing some of the challenges that we've seen, with the increasing digitalization to date, and seeking to try and avoid some of those consequences going forward as we move into an ever more digitalized world. Just some references there. Thank you very much for your time, and look forward to the discussion and the questions.
Thank you very much, Caroline, for this very insightful presentation, also because you touch upon, it's very interesting aspects which go beyond the purely financial aspects, and touch upon, issues which are of relevance to ordinary people, and so that it's we can understand, the whole complexity of the subject we are talking here today. So let me now turn to the panelists. We are running out of time, but we have a very interesting panelist waiting for expressing their views. We have with us today Yoon, Cheng, and Saiful Islam. Apologies for my pronunciation. Yoon is a research fellow at the Department of Market Policy Research in the Korea Development Institute. She has produced major papers on the effects of government-supported financial products for low credit-rated and small business owners, and served as member of the Financial Development Council for the Financial Services Commission. Cheng is Associate Professor to the School of Economics and Executive Director of the Research Center for Digital Economy of the Renmin University of China. Her research mainly deals with digital economy and fintech. And finally, Saiful Islam is Director of Treasury Information System Technology in the Directorate General of Treasury of the Indonesian Ministry of Finance. He supports the Minister of Finance in the area of institutional transformation linked to the digital area. Perhaps we can start with Yoon. Yuneho, what are your takeaways from the presentation that we had today? So I would give the floor to Yuneho. Are you there?
Good afternoon.
Okay, thank you very much, Yuneho. Let's go.
Thank you. Good afternoon, everyone. I am Yoon in Korea Development Institute. It's my honor to discuss on this topic with these renowned experts. I declare this presentation show my point of view, not representing KDI. Let me start with the policy concerns on stablecoins. Stablecoins contributed to the spread of digital currency, intermediating between high volatile virtual currency and real money. However, though stablecoins act like bank deposits in the virtual currency market, issuers may lack cash like the Tether's case. If they issue coins beyond the amount of the actual customer's deposit, it may threaten financial stability and consumer protection. Therefore, EU recently prepared the related regulations, and US Treasury Secretary also raised urgent need for regulation. In each country, financial authorities may need to consider applying strict regulations like banks on major stablecoin issuers, such as equity capital ratio. Next, let me move to the potential risk of CBDC. In respect to domestic CBDC, it can enhance the convenience of payment and financial inclusion, and can reduce cash issuance cost. Minus interest rate policy might be also possible with CBDC. However, there are concerns on this CBDC, including invasion of privacy and weakening of bank intermediary function. With massive transaction data concentrated on few limited institutions, cybersecurity and data protection issues also rise. On the other hand, with cross-border CBDC, the cost and time for foreign currency exchange transaction can be drastically reduced. At the same time, it may accelerate the currency substitution like dollarization. Integration of the international capital market may also weaken its country's autonomy on foreign exchange policy or monetary policy. Now, here, I want to raise several issues to be discussed about CBDC. Firstly, central banks need to ask the fundamental questions before the preparation of CBDC. Why do we need CBDC? Are the advantages like the convenience are important enough to bear all possible adverse effects? What is the problem of the current payment system? Is it difficult to solve without CBDC? In South Korea, there is a high demand for cash. The use of credit cards and the degree of financial inclusion is high. So the advantage of CBDC is not to be significant to endure all the anxiety about consumer protection and financial stability. So there is a concern that several countries may competitively issue CBDCs without required review of these adverse effects. Secondly, international cooperation is required to minimize adverse effects in developing related technology on CBDC. Especially, anonymity in CBDC is limited, unlike cash. To comply with anti-money laundering and counter-terrorism financing regulations, funds flow should be tracked to some extent. Moreover, some countries may consider applying distributed ledger to CBDC, but it is still unstable technology. Thus, international cooperation is required to develop technology for privacy and stability. Thirdly, the relationship between CBDC and stablecoins should be considered before designing CBDC. The impact of dollar CBDC would be most notable, and the roles of stablecoins and CBDC may overlap. So the demand for stablecoins may decrease after the realization of dollar CBDC. On the other hand, in the presence of the current dollar-based stablecoins, the advantage of dollar CBDC would not be prominent. In addition, there is a possibility that privately issued stablecoins can be leading international currencies in the future. Therefore, the macroeconomic implication of this situation should be examined, and policies other than issuance of dollars CBDC should be explored in advance. Lastly, we may need to balance between convenience and financial stability. Even if technology on cross-border CBDC can enhance the speed of cross-border currency transaction, a concern on currency substitution or capital market integration would be considerable. Thus, the regulation on limiting the speed or amount of foreign transaction through CBDC could be required in some cases, despite the advanced technology. Thank you for listening. Oh, we cannot hear your voice.
Okay, sorry. Can you hear my voice now? So apologies. So thank you very much, Yoon. I would like now to call Cheng for her comments to the presentation. Cheng, sorry.
Okay. Good morning and good afternoon. Just now, Ms. Malcolm gave us a comprehensive and perceptive presentation about CBDC. I just want to give my observation about this topic from the perspective of China's CBDC. China's CBDC is named as ECNY, which means Electronic China Yuan. Why electronic, but not digital? I don't know why. This name is named by government. ECNY is kind of retail central bank digital currency. Although now it is still testing period in China, but ECNY has got a large number of users. Till June this year, over 20 million people and over 5 million firms has opened ECNY accounts. In her presentation, Mrs. Malcolm gave us 5 reasons on why create a CBDC, but among them, I have doubt on if ECNY in China can enhance the payment system's efficiency and improve the financial inclusion. From 2010 in China, non-bank payment institutions such as Alipay and WeChat Pay did a good job. Through VI code mobile payment, China almost accomplished cashless society. Almost all person, except for children and people, can make use of a mobile payment everywhere. And many women and young men and small firms can get the loan from this institution. I mean, in the last decade, non-bank payment institution did a good job in payment system and financial inclusion in China. So the Chinese government issue CBDC. Maybe I think another reason is important. Another reason is to issue CBDC is to enhance the ability of a central bank to control the financial system. The ability of a central bank to control financial system, I mean, for example, through the ECNY system, we can know this central bank has announced some details about this system. We can know the central bank can get the almost all the big data about the payment and settlement debt, about every people and every firm and every exchange. So they can.
Cheng, sorry to intervene. We are very running late over time. So if you could synthesize your intervention, just to leave also time to our colleagues. Yeah, thank you.
Another example is the central government can give loan directly to the person or firm they want to give. So my meaning is when discuss issue CBDC. The evaluation standard on which currency is good include not only convenience, efficiency, or safety, but also the distribution of financial right. I think it is a key point in China. Okay, that's all. Thank you very much.
Thank you very much, Cheng. We are really out of time. I would like to invite Saiful for its intervention, and I would plead him to be very short. I'm sure that it will be able to finish rapidly. Thank you.
Okay, thank you, Ms. Gelsomina. Good afternoon or good evening. It is great pleasure to be here today. Thank you to MOEF and KDI for this invitation. What I express in this session is not represent the official standpoint, rather it is my personal perspective or viewpoint. In my discuss today, I will address the digitization of money. So the basic question, does the economy need digital currencies? Digital money itself is not new. Commercial bank money has been digital for decades, and we already use digital means of payment on a daily basis activities. Central banks already provide wholesale digital money to banks. New forms of digital money, either publicly or privately provided, would be the latest innovation in an evolving landscape for the way in which payments are made in the economy. They could contribute to faster, cheaper, and more efficient payments, and they could potentially enhance financial inclusion, but they could also carry risk. Recently, payments typically rely on the use of either cash or deposit held in commercial banks, referred to as commercial bank money. If new form of digital money are to become widely used as a trusted form of retail payment, it is essential that the public can have some confidence in them as they have in existing forms of money. Public confidence in money is main focus to the central bank's objective. So it is the foundation of both monetary and financial stability. Monetary policy seeks to maintain the stability of prices for the goods and services people consume. Financial stability seeks to avoid interruption in the provision of financial services that people rely on. Implications for monetary and financial stability arise because commercial banks and the money they create through lending are an important part of the economy. By offering people an alternative to commercial bank money, new forms of digital money could affect the cost and availability of borrowing from banks. All else equal, they could make it more difficult for monetary policy to ease financial condition. Against that, new forms of digital money could increase the resilience of payments. New forms of digital money could potentially offer benefits in terms of cost and functionality, and there could be potential gains from a shift to more market-based financing. It is also possible that they could enhance the transmission of monetary policy. But these opportunities can only be realized if new forms of digital money are safe. They could be privately provided in the form of stable coins, or they could be publicly provided in the form of central bank digital currency. So the presenter, Ms. Caroline, presented new forms of digital currencies or digital cash that have been in the news lately, particularly central bank digital currencies or CBDC. If we need digital currency of these new kinds, who should issue them and how should they be designed? What are the implications of digital currency for the monetary system? These are weight issues that are much on this mind on central bankers, scholars, and the general public as well. There are three fundamental questions that need to be addressed. Firstly, do we need new digital currency? If so, who should issue them? Today, we have the possibility to produce a technologically superior representation of central bank money. This can combine novel digital technologies with tried and true characteristics of central banks, such as trust, transparency, legal banking, and finality that others would need either rely on or create for themselves from the ground up. The second question, how do we designing CBDCs for the benefit of societies? CBDCs can be designed to preserve the two-tiered financial system as like a public-private partnership. Several decades ago, we're familiar with the public-private partnership scheme. In terms of involvement by the private sector, we should not think only about model where the central bank provides retail services directly. From the user perspective, a successful retail CBDC would need to provide resilient and inclusive digital complement to physical cash, but that does not prevent an important role for the private sector. The third question, what are the implications for the monetary system? If they are properly designed and widely adopted, CBDCs should become a complementary means of payment that address specific use case and market values. They could act as a catalyst for continued innovation and competition in payments, finance, and commerce at large. So as conclusion, sound money is central to our market economy, and it is central banks that are unique placed to provide this. If digital currency are needed, central banks should be the ones to issue them. If they do, CBDCs could also play a catalytic role in innovation, spurring competition and efficiency in payment. In this slide, even the fires related to the COVID-19 pandemic, central banks around the world have to step up their CBDCs design effort. They should not be seen primarily as a reaction to the emergence of the cryptocurrency or the announcement of corporate stablecoin project. Rather, they are proactively researching a new form of money and how it could improve retail payment in digital area in line with the central bank's mandates. However, developing CBDC comes with a host of technological, legal, and economic issues that warrant careful examination before issuance. Central banks, the guardians of stability, will proceed carefully, methodically, and in line with their mandates. Issuing a CBD, therefore, is a national choice. Wherever issued, careful design such as the architecture defining the roles of the central bank and private intermediaries would ensure they preserve the two-tier financial system, and the monetary policy implementation and financial stability will not jeopardized.
Sorry, Saiful, we should try to finalize the presentation. It's very, very late.
Okay, so this is actually just 3 items that need to be discussed later on, whether how made the new form of digital money affect money and credit creation. And the second thing regarding the protection and privacy, what will be regarded as a minimum setup protection, it is very important. And the last thing, what step could be taken and by whom to promote interoperability of new form of digital money with other payment system, and thereby foster a competitive environment. Those 3 things, according to me, they're very important to be discussed. Thank you.
So thank you very much. I think that unfortunately there isn't time for question and answers. We got very rich presentation by all speakers and panelists. I would also refrain from taking any conclusion. It's really very late, and I do not want to penalize also the next session. So let me just thank everyone for their presentation. I think that we had actually a lot of food for thought for these very important topics. And so let me thank again the organizer for this very interesting conference, and all the speakers and panelists for their interventions today. Have a nice day, afternoon, and night to everyone. Goodbye.
Goodbye.
Bye. Thank you.
Thank you.
Thank you. Thank you very much. I'd like to thank everyone who gave us the opportunity to look into the presence of the rapidly changing financial markets. Thank you very much once again. And additionally, I would like to thank our online and offline participants for their questions, along with their interest and participation. Thank you so much once again. This concludes session 2, and ladies and gentlemen, now we'll take a little break for about 5 minutes. We'll come back with the session 3 after 5 minutes. Thank you very much.